In this video, we will delve into the fascinating world of crypto assets, exploring their significance in today's financial landscape. Viewers will gain a comprehensive understanding of what crypto assets are, including their various forms, such as cryptocurrencies, tokens, and digital collectibles. We will discuss the underlying technology, blockchain, that powers these assets and how it revolutionizes traditional finance. Understanding crypto assets is crucial in our rapidly evolving financial environment as they present new opportunities for investment and wealth creation. As we navigate through this topic, we will highlight the potential benefits and risks associated with investing in crypto assets. Join us as we uncover the transformative potential of crypto assets and their role in shaping the future of finance. Crypto assets are digital representations of value that leverage blockchain technology to facilitate transactions and ownership. They can be broadly categorized into three main types: cryptocurrencies, crypto commodities, and crypto tokens. Cryptocurrencies, like Bitcoin and Ethereum, are designed primarily as a medium of exchange and a store of value, functioning similarly to traditional currencies but operating on decentralized networks. Crypto commodities, on the other hand, represent tangible assets or utilities, such as gold or oil, and are often used in specific applications or platforms. Lastly, crypto tokens are digital assets that can represent a variety of things, including access to a service, voting rights within a decentralized application, or even a stake in a project. The backbone of these crypto assets is blockchain technology, which is a distributed ledger that ensures transparency, security, and immutability of transactions. Each transaction is recorded in blocks that are linked together, creating a chain that is nearly impossible to alter. This technology not only supports the existence of crypto assets, but also enables smart contracts, which automate and enforce agreements without the need for intermediaries. Since the inception of Bitcoin in 2009, the landscape of crypto assets has evolved dramatically. Initially, Bitcoin was the sole player in the market, but as awareness and interest grew, thousands of alternative cryptocurrencies and tokens emerged, each with unique features and use cases. This evolution has led to a diverse ecosystem where investors and users can explore various opportunities, from decentralized finance, DeFi, to non-fungible tokens, NFTs. Understanding the distinctions between these types of crypto assets and the technology that underpins them is essential for anyone looking to navigate the complex world of digital finance. Bitcoin's journey began in 2009 when an anonymous entity known as Satoshi Nakamoto introduced it through a white paper titled Bitcoin, a peer-to-peer electronic cash system. This marked the inception of the first decentralized cryptocurrency, designed to operate without a central authority, allowing peer-to-peer transactions over a secure blockchain network. Initially, Bitcoin was met with skepticism and limited adoption, primarily used by tech enthusiasts and those interested in cryptography. However, as the years progressed, Bitcoin began to gain traction, leading to significant milestones that would shape its path to becoming a mainstream asset. In 2010, Bitcoin's first recorded price was just a fraction of a cent, but by 2011, it had reached the $1 mark, capturing the attention of a broader audience. The following years saw dramatic price fluctuations, with Bitcoin reaching $266 in April 2013 before crashing to around $50 later that year. Despite these volatility challenges, Bitcoin's adoption continued to grow, with more merchants beginning to accept it as a form of payment and the establishment of exchanges that allowed users to buy and sell Bitcoin more easily. A pivotal moment in Bitcoin's history occurred in late 2017, when its price skyrocketed to nearly $20,000, drawing massive media attention and attracting a wave of new investors. This surge marked a turning point as institutional interest began to emerge, with companies and financial institutions exploring ways to integrate Bitcoin into their operations. The subsequent market correction in early 2018 did not deter Bitcoin's growth. Instead, it led to a maturation of the market, with increased regulatory scrutiny and the development of more robust infrastructure. Bitcoin's significance as the first crypto asset cannot be overstated. It laid the groundwork for the entire cryptocurrency ecosystem, inspiring the creation of thousands of alternative coins and tokens. Its decentralized nature challenged traditional financial systems, promoting the idea of a borderless, censorship-resistant currency. As Bitcoin continues to evolve, its role as a store of value, often referred to as digital gold, has solidified its position in the financial landscape, making it a critical asset for both individual and institutional investors. Understanding Bitcoin's historical context and growth is essential for grasping the broader implications of cryptocurrency in today's economy. Analyzing the market dynamics surrounding crypto assets reveals a complex interplay of various factors that influence their prices and overall market behavior. One of the primary factors affecting the price of crypto assets is market sentiment, which can be driven by news events, regulatory developments, technological advancements, and macroeconomic trends. Positive news, such as institutional adoption or favorable regulations, can lead to bullish sentiment, driving prices higher, while negative news can trigger panic selling and price declines. Additionally, the speculative nature of the crypto market often amplifies these reactions, as traders and investors react quickly to perceived opportunities or threats. Supply and demand play a crucial role in determining the price of crypto assets. Unlike traditional assets, many cryptocurrencies have a fixed supply, which can create scarcity and drive prices up when demand increases. For instance, Bitcoin has a capped supply of 21 million coins, meaning that as more people seek to acquire Bitcoin, the limited availability can lead to significant price appreciation. Conversely, if demand wanes, or if new projects flood the market with alternative assets, prices can decline sharply. This dynamic is further complicated by the fact that many crypto assets are traded on various exchanges, each with its own liquidity and trading volume, which can lead to price discrepancies across platforms. Market sentiment and speculation are intertwined with the supply and demand dynamics, often leading to extreme volatility in the crypto market. Traders frequently engage in speculative behavior, driven by the potential for high returns, which can lead to rapid price swings. Social media, forums, and online communities play a significant role in shaping market sentiment, as discussions and trends can quickly influence investor behavior. The fear of missing out, FOMO, can drive prices up as more investors rush to buy in during a bullish trend, while fear, uncertainty, and doubt, FUD, can lead to mass sell-offs during downturns. Understanding these market dynamics is essential for anyone looking to navigate the crypto landscape, as they highlight the importance of informed decision-making in a highly volatile environment. When it comes to investing in crypto assets, developing effective strategies is crucial for navigating the inherent volatility and risks associated with this market. One of the most important principles of investing is diversification. By spreading investments across a variety of crypto assets, investors can mitigate risk and reduce the impact of poor performance from any single asset. A well-diversified crypto portfolio might include a mix of established cryptocurrencies like Bitcoin and Ethereum, along with smaller altcoins that have potential for growth. This approach not only helps to balance risk, but also allows investors to capitalize on different market trends and opportunities. In addition to diversification, implementing robust risk management techniques is essential for anyone investing in volatile markets like cryptocurrencies. One effective strategy is to set clear investment goals and establish a predetermined risk tolerance. This involves determining how much capital an investor is willing to risk on each trade and setting stop-loss orders to limit potential losses. Another technique is to avoid investing more than one can afford to lose, which helps to prevent emotional decision-making during market fluctuations. Additionally, regularly reviewing and rebalancing the portfolio can ensure that it remains aligned with the investor's goals and risk tolerance. Thorough research is a cornerstone of successful investing in crypto assets. Before committing funds, investors should take the time to understand the fundamentals of the assets they are considering, including the technology behind them, the team involved, and the market demand. Analyzing historical price trends, market sentiment, and potential regulatory impacts can provide valuable insights into the viability of an investment. Engaging with reputable sources of information, such as white papers, industry reports, and expert analyses, can further enhance an investor's understanding and confidence in their decisions. By prioritizing diversification, employing effective risk management techniques, and conducting thorough research. Investors can navigate the complexities of the crypto market more effectively and position themselves for long-term success. Examining the regulatory environment surrounding crypto assets is essential for understanding the landscape in which these digital currencies operate. Regulatory bodies play a crucial role in overseeing crypto markets, ensuring that they function fairly and transparently while protecting investors from fraud and market manipulation. In many countries, agencies such as the Securities and Exchange Commission, SEC, in the United States, the Financial Conduct Authority, FCA, in the UK, and the European Securities and Markets Authority, ESMA, are tasked with establishing guidelines and regulations that govern the use and trading of cryptocurrencies. These bodies are increasingly focusing on issues such as anti-money laundering, AML compliance, Know Your Customer, KYC requirements, and the classification of crypto assets as securities or commodities, which can significantly impact how these assets are treated under the law. Recent regulatory developments have further shaped the crypto landscape, with various jurisdictions implementing new rules that can have profound implications for investors and businesses alike. For instance, the introduction of stricter regulations in countries like China, which has cracked down on cryptocurrency trading and initial coin offerings, ICOs, has led to increased uncertainty and volatility in the market. Conversely, some countries, such as El Salvador, have embraced Bitcoin as legal tender, signaling a more favorable regulatory stance that could encourage adoption. These contrasting approaches highlight the importance of understanding the regulatory environment, as changes can affect market dynamics, investment opportunities, and the overall growth of the crypto ecosystem. Speculating on the future trends and developments in the crypto space reveals a landscape ripe with potential innovations and advancements, particularly in blockchain technology. As the foundational technology behind cryptocurrencies, blockchain is expected to evolve significantly, leading to enhanced scalability, security, and interoperability among different networks. Innovations such as Layer 2 solutions, which aim to improve transaction speeds and reduce costs, are already being developed and implemented. Additionally, advancements in decentralized finance, DeFi, and non-fungible tokens, NFTs, are likely to drive further exploration of blockchain applications beyond traditional financial transactions, potentially transforming industries such as art, gaming, and supply chain management. The growing acceptance of crypto assets in mainstream finance is another trend that is likely to shape the future of the crypto market. Major financial institutions, including banks and investment firms, are increasingly recognizing the value of cryptocurrencies and blockchain technology. This acceptance is evidenced by the launch of crypto-related financial products, such as exchange-traded funds, ETFs, and custodial services, which provide investors with more accessible ways to engage with digital assets. Furthermore, as regulatory frameworks become clearer and more supportive, we can expect to see an influx of institutional investment. Encouraging viewers to consider the long-term potential of crypto investments is essential, as the market is still in its early stages of development. While volatility and uncertainty are inherent in the crypto space, the underlying technology and its applications offer promising opportunities for growth. Investors who take a long-term perspective and remain committed to understanding the evolving landscape may find themselves well-positioned to benefit from the transformative potential of cryptocurrencies and blockchain technology. In summarizing the key points discussed in this video, it is essential to emphasize the importance of understanding crypto assets for investors. As the financial landscape continues to evolve, having a solid grasp of what crypto assets are, their various types, and the underlying technology is crucial for making informed investment decisions. We explored the historical context and growth of Bitcoin, highlighting its significance as the first crypto asset and its role in shaping the broader market. Additionally, we analyzed the market dynamics surrounding crypto assets, including the factors influencing their prices, the impact of supply and demand, and the effects of market sentiment and speculation. As we conclude, we encourage viewers to take action with a like and subscribing to our channel, The Wealthy Wallet, and exploring related content to deepen their understanding of this dynamic field. The evolving crypto landscape presents numerous opportunities for those willing to engage and learn.